Hi everybody. In this video, I will explain about the third step in the accounting cycle. In the previous video, you have seen that you have seen the step 1 in the accounting cycle. Step one in the accounting cycle is the analysis step. When a transaction happen, you analyze the transaction. When you analyze the transaction, it happen only in your head. And then you do the second step. The second step is you record the transaction in the journal. You have seen how to record the transaction in the general journal. So the general journal, you have to record the transaction in the journal according to the time it happened. When it happened, you record in the journal. So, and then you have to record the transaction every time it happens. And then at the end of an accounting period, maybe at the end of the month or at the end of the year, you have to stop recording, because in accounting we have the principle of time period. You assume that the business life can be divided into an accounting period, maybe 1 month or maybe 1 year or 6 months. That depends on the business. So when you stop recording in the journal, you have to do the step 3 in the accounting cycle. In this step, the step is you prepare the ledger. Okay, remember this. Journal is the second book. Journal is the first book that we use in accounting record. Ledger is the second book. Ledger is a book that you use to record the you have to use to record the business transaction. So this is a book. Okay, and in the ledger there are many accounts. One item is related to one account. The account is like this. The name of the item, for example, for cash, you have cash, and then there is an account for cash. We call it T account. In the ledger, there are many T accounts. Account for cash, account for receivable, revenue, capital, etc. For every item, there will be one account. Okay, now let's see how to prepare the ledger. Okay, like I told you earlier, when you do step 2, you refer to step 1. When you do step 3, you have to refer to the step 2 of the accounting cycle. So this is the step 2 that we have done before. You have seen how to record the transaction in the journal. So when you want, this is step 2. When you want to do, this is step 2. When you want to do the step 3, you have to refer to step 2. Okay, now we start doing the or preparing the ledger. The process of preparing the ledger is called posting journal entries into the ledger, or transferring all the journal entries into the T accounts. So like I said earlier, in the ledger there are many T accounts. You have to prepare many T accounts. So see how to transfer these journal entries into the ledger, into the T accounts. So you have to prepare the account, many T accounts. So the first one, okay, let's see. Yeah, many T accounts. So for every item in the journal, there will be one account for each item. So now how to transfer these journal entries into the ledger. This is the ledger. Okay, see here. the first journal entry is debit cash and then credit capital 20,000. So when you see this one, debit cash, so you know you have to create an account for cash. So this is the T account. So you have to give cash a T account. So you create an account for cash. So here the date is the date is number 1, debit cash 20,000. So you create account cash and then see here debit account cash. So in accounting, debit means left, credit means right. So when the first journal entry is debit cash 20,000, so you create account cash, you have to debit account cash. So debit account cash means you have to record in the left side of account cash. So you're supposed to write the date here, but now we use number 1, so we put number 1. This is the cash account. You debit account cash 20,000. So this is cash account, you debit 20,000. So here you debit account cash. Why you debit account cash? Because there is an increase in capital, or in other words, we can say that cash increase because of capital. So the account cash debit 20,000. You have to refer this increment in account capital. You write capital here. Okay, that is the thing to do. So you can tick this transaction. You have transferred this transaction into the ledger. You have transferred this entry into the ledger or account. Okay, now the second entry, credit capital 20,000. The name of the account is capital. So you have to create an account for capital. So now you create account for capital, an account for capital. You create an account for capital. Now the journal entry says you have to credit account capital 20,000. This is account capital. When you credit the account, you have to record in the right side of the account, because credit means left. So the date is 1, credit account capital 20,000. 20,000. Refer to which account? Okay, you refer to account cash. When you record the capital, you refer account cash. When you record cash, you refer to account capital. So here in account capital, you credit account, you refer to account cash. Here cash you debit, refer to account capital. Capital you credit, refer to account cash. Okay, that is the way to do it. Okay, you have done this. Journal entries for transaction 1 have been posted to the ledger. Okay, so now you have to do the same thing to every account. So to every journal entries. Okay, see here, number 2 is debit equipment 6,000. So there is no equipment account here. You create an account for equipment. So you create an account for equipment. Okay, here debit equipment 6,000. So this is account equipment. The transaction is number 2. You debit the account equipment 6,000. Refer to which account? Refer to account cash. So you write here cash. Okay, don't ask me why. This is the way to do it. You debit account equipment, refer to account cash. And then you here journal entry, you credit account cash 6,000. Okay, you already has the account cash. So this is account cash. You have to credit this account. The amount is 6,000. The transaction number 2, credit account cash 6,000. You write here 6,000. You refer to account. Credit account cash refer to account equipment. So you debit account equipment refer to cash. Credit account cash refer to equipment. Okay. Now this one has been done. You have to do the same thing to other accounts. So debit supplies 500. There is no account supplies. You create an account for supplies. Okay. Debit supplies 500. The transaction is number 3. So you put here. It's supposed to be the date of the transaction. Debit supplies 500. Refer to account cash. Refer to account cash. Done. Credit cash 500. You already has the account cash. So credit account cash 500. Refer to which account? Refer to account supplies. You write here supplies. Why you have to do something like this? Because when you open account cash, you see here, this is cash in, this is cash out, and then you want to know why there is a cash in. Because there is a capital goes into the business. Why there is a cash out? Because of purchasing equipment and purchasing supplies and maybe other things. So that is done. And then do the same thing here for number 4. Debit cash $10,000. So cash, you debit the transaction number 4, $10,000. Refer to account bank loan. Bank loan. There is no account bank loan yet, so you create an account for bank loan. Bank loan. Okay. You have already recorded or transferred this. Now you transfer this. Bank loan credit 10,000. Bank loan credit 10,000. Refer to what account? Refer to account cash. So you write cash. This is done. And then you have to do the number 5. Journal entry number 5. Debit account receivable. There is no account receivable yet. You create an account for that. So we make it here. Account receivable. It is an asset. So you debit account receivable 100. So you write the date is 5. The amount is 100. Refer to account revenue. You write here revenue. Okay. And then the last one is credit revenue 100. There is no account for revenue yet, so you create an account for revenue. Okay. Revenue, credit revenue 100. So here is the credit side. 5 credit 100. The refer to account receivable. Account receivable. Okay. So you have done the process. You have posted all journal entries. Here are journal entries. You have posted all these journal entries into the ledger. Okay, done. So when you have transferred all the journal entries into the ledger, the next step, the next thing to do is you have to calculate the balance of every account. You have to calculate the balance of every account in the ledger. So how to calculate the balance of all accounts in the ledger? So you have to do it one by one. So see here. So to calculate the balance, you have to do this step. This is the way. You have to do the same thing for every account. So first, you have to calculate the total number in the debit side and total number in the credit side. So here, for example, the total number in the debit side is 30,000. The total number in the credit side is 6,500. So which one is the highest? This one is the highest. The highest number is 30,000. This one smaller, 6,500. So you write the highest number, 30,000. In the both total, you write the highest number. Now, after that, you have to calculate the difference. This one is 30,000. This one is 6,500. What is the difference? The difference is 23,500. 23,500. For this difference, you name it as ending balance. Ending balance for account cash is 23,500. What is the logic? The logic is like this. This is account cash. The total cash in equal to 30,000. The total cash out is 6,500. So the ending balance of cash is 23,500. Okay, that is the logic. So you have to do the same thing for every account. In this example, other accounts have only one item. So easy. But maybe when you do other questions, every account will have several item in the debit side and also several item in the credit side. So in that case, you have to do this way to calculate the ending balance. So now easy for you here. The ending balance is like this. The highest number for capital is 20,000. 20,000. So the ending balance is 20,000. Here 6,000, supposed to be also 6,000 here. So ending balance is 6,000. 500, 500. Ending balance 500. Okay, the logic is like this. Supplies during this example, for this example, there is an increase in supplies 500, but there is no supplies out. So at the end of the accounting period, at the end of the month or at the end of the year, $500 of supplies left unused. Okay, bank loan, for example here, 10,000. At the end of the month or at the end of the year, for this sample, very simple sample, the balance of bank loan is still 10,000. The business has not paid the bank loan yet. If the business paid the bank loan, then the balance will decrease. So account receivable is 100. So here supposed to be 100. So the ending balance is 100. Here 100. Here 100. Ending balance is 100. So actually, if you have a date, then you have to write the date here. For example, 31st of December is the date. Then you have to write the date and then the ending balance. Here also for every item, it's, if you have the date, then you put the date. But in our simple example, we use number, so we just put the number. Thank you very much. This is the way to prepare the ledger. Remember, ledger is another book that we use in accounting. Inside the ledger, there are many accounts. The accounts is called T accounts because the shape of the account is like a T. In the ledger, if you want to know, in the ledger, at the beginning page of the ledger, there is something called chart of account. The chart of account is like book contents. The chart of account lists all the accounts in the ledger with the code. Every account has a code. So that's the detail about it. But in a simple way, in the ledger there are many accounts. So you have to show things like this, the name of the account, and then you have at the end of the process, you have to calculate the ending balance for each account. Thank you very much. Do not forget to write your name and matric number in the comment section. And don't forget to watch the next video. The next video where I will explain about the step 4 in the accounting cycle, which is preparing the trial balance.